Good morning. Good morning. I'm Phil Aldrick from Bloomberg, and this is the Monetary Policy Outlook panel. So we've had the Fiscal Outlook panel, and now Monetary Policy. So that is at least the correct order because monetary policy has to follow the fiscal position, of course. The Deputy Governor this morning was saying that the outlook is clouded, so there certainly will be a lot to chew on. So on this panel, we've got Megan Greene, the resident Monetary Policy Committee member here. She's been in that position since 2023, has various teaching roles at the London Business School, at posts at the San Francisco Fed, Chatham House. She was chief economist at Kroll, and I remember her most from the Eurozone sovereign debt crisis days, where you were on the TV screens an awful lot. Katharine Neiss, Chief European Economist for PGIM Fixed Income, the sponsors here, an expert on monetary strategy and trade, so a perfect panelist this morning, and was a senior economist at the Bank of England, and Gianluca Benigno, professor of economics at Lausanne University, a former head of international research at the New York Fed, was a professor at the London School of Economics, and has a long history of central banking and monetary, macroeconomic policy making. So we're going to start off with the three presentations, and Megan, I believe you're going first.
Thanks. Hello? Does this work? I can shout. I'm American, so.
Maybe the...
There, maybe my lapel mic's working a little bit better. Can you guys hear me, really? Okay, great. Thanks. Thanks so much. It's a real honor to be here. Thanks to you guys for coming. I thought I would start off just by talking about our latest forecast, which we just put out last Thursday, and then spend a bit more time talking about the things that have really informed my monetary policy views in the last round, but over the past couple of rounds as well. So where are we now versus where we were at the start of the year? Our forecast actually hasn't changed a whole lot. We've revised our GDP growth forecast up a little bit in the short term. That's mostly mechanical, given that the GDP data, the monthly GDP data, has come in stronger than we had expected. Our unemployment forecast was revised up a little bit as well. And our inflation forecast has been revised downwards relative to February a bit, partly driven by energy costs, which have just come in lower. So our latest forecast isn't hugely different from the previous one, even though so much has been happening in the world. It's partly a reflection of a global demand shock, but also, as you guys will know, our forecast is predicated on a bunch of conditioning assumptions, including asset prices, which move quite a lot, too. The overall headline is that we believe the disinflationary process is still underway, and I believe that as well. There are some differences in view among the committee on how quickly that's progressing, but there is agreement on that. These are actually the three indicators of inflation persistence that we've been looking at since before I even joined the MPC. And they're moving in the right direction, but in my view are still too high. So the chart on the left is looking at services inflation. You can see that that's been coming down, looking at a whole bunch of different metrics, but it's coming down pretty slowly and remains above kind of target consistent levels. The chart in the middle is looking at pay growth. We look at a whole bunch of different indicators for pay growth. We also put some weight on our agents' pay survey, which suggests settlements should come in at around 3.7% by the end of the year. Again, everything's moving in the right direction, but is still too high and is above target consistent levels. And then finally, the last chart is just looking at the labor market, and some slack has opened up in the labor market in our estimation, which is moving things in the right direction for inflation to come down sustainably to our 2% target. There are a few things to worry about, and that's what I'm going to spend the rest of my time on. One is, as you know, we have this near-term hump in inflation in our forecast now. That's in the chart on the left. You can see a hump in inflation. It's way smaller than the previous hump that we had, so it's not even in the same order of magnitude. Also, the labor market environment is pretty different now relative to then, so the labor market is loosening. But there is a question about whether individuals and businesses will be more sensitive to this near-term hump in inflation. And for that reason, I've included two charts looking at inflation expectations. The one in the middle is looking at short-term household and business expectations. You can see that they've ticked up, and not just recently. They've been ticking up for a while, and that's for 1 year ahead. So there is a sense that maybe households in particular are a bit more sensitive to increases in inflation given the shock that we had previously experienced a couple of years ago. What's a little bit more worrisome for me is that medium-term inflation expectations have also started ticking up. Now, we can look at what kind of normal relationships are between inflation and inflation expectations. And actually, most of these inflation expectations metrics are within the band of what we expect. Not all, but most of them. But they do tend to be towards the top. So I do think that that's something that I'm worried about and continue to look at. There's a key question about whether weakness in activity has been more supply or demand driven. It's something that Claire mentioned earlier this morning. And it's something I've been thinking about a lot. I wanted to show you some results from a model that the staff have run, an SVAR model, which is a data-based model that looks at shocks to the economy and figures out which shocks are causing deviations from the long-term trend. So in the section on the left, I show sort of global and UK demand and supply shocks. What's important, in my view, to notice is that actually it's the green one, is that there is some evidence that there's been a negative supply shock in the UK. It got slightly less pronounced in Q1 relative to the previous quarter. Q1's the latest data that we have. But it does suggest that there is a supply constraint on the economy. In the chart on the right, again, this is just looking at what's causing deviations from the long-term trend. And you can see the yellow bar is supply. That's dragged down. So there is an argument that while often short-term fluctuations in activity are demand-driven, there could be supply constraints at play here as well. Looking at the productivity data, that shouldn't come as a huge surprise. This is just plotting out productivity growth over the course of a number of periods. It's been negative recently. That's highly unusual when we're not in a recession. So there is a puzzle around that, why productivity has been contracting more recently. So there's questions about kind of where we are, but also in our forecast, we assume that we go back to trend growth in productivity growth. And in my view, I think the risks to that assumption are on the downside. So I am worried about the supply side of the economy, which all else equal would tend to be a bit more inflationary. But of course, that's not all that's going on these days. We also have, hang on, this is a different deck than I submitted. That's fine. We also have, of course, trade going on. And this is another aspect that has certainly influenced my views, particularly in the last round. So I don't want to overstate the impact of trade on the UK economy. As was mentioned earlier, about 70% of the UK's exports to the US are actually services, so aren't directly impacted by tariffs. But that said, the UK is a small open economy, so there are a lot of indirect effects that would hit the UK economy and inflation as well. There's trade policy uncertainty, which I've got in a chart here. You can see it's really shot up, which is no surprise, but that tends to cause businesses in particular who are trying to make long-term decisions about capital outlays to sort of wait and see. So that has a cooling effect on growth and therefore inflation. And then you can see in the chart on the right, we've asked firms how they're thinking about sales in light of trade, and it's no surprise that U.S. exporters think that sales will fall. So again, it just suggests that there could be sort of a global demand shock from trade. This is a chart I just pinched from my own speech, actually, which I gave in February based on really excellent bank staff work, but looking at kind of the channels of propagation for tariffs through to the UK economy in the event of no retaliation and retaliation. Just to give you the cheat sheet, the big difference in lines is the exchange rate movement, which depends on whether you have retaliation or not. As I mentioned, tariffs represent a global demand shock. There's also a channel of trade diversion, which could be, on balance, disinflationary. Exchange rates, as I mentioned, are a big input in terms of how tariffs might feed through into the UK economy, and exchange rates haven't necessarily gone as economic theory would lead you to expect. So the pound is, the sterling ERI is up moderately since Liberation Day. If that continues on balance, that could be disinflationary for the UK economy. All of this ignores a few things that don't tend to be in models, one of which is just supply chain repatternings. We learned during COVID that can be quite inflationary, and that doesn't tend to come into the models. And also, if you have broader sort of trade fragmentation, then that tends to reduce knowledge spillovers and competition. So on balance, that reduces potential growth. That could be inflationary as well. So the implications are in both directions. Our challenge is to try to net these all up with tariff policies changing all the time. So it's no easy task. I think on net, tariffs will probably be disinflationary for the UK economy. And that was a factor in determining my most recent decision to cut bank rates by 25 basis points. So there are some inflationary factors. I think on net, there are more disinflationary ones. They'll all hit the economy at different times. But that's certainly a risk that I'm looking at. I will leave my comments there. Thanks.
Thanks very much.
So I was just going to make three very brief points. One is obvious, one is sort of semi-obvious, and the third one is a bit speculative in the hopes of generating a bit of a discussion. So in terms of the first kind of obvious point, this chart is just showing you a version that you've probably already seen today. We have nominal wage growth, we have UK inflation. And it's really just that, given the huge inflation shock that we're only just now seeing the back end of, the COVID, the energy shock, and given that both UK nominal wages and inflation are still running at rates that are too high relative to the 2% target, it's just really hard for the Bank of England to be preemptive. And that's not unique to the Bank of England. We're seeing that in other major central banks. So for example, in the euro area, services inflation is still running quite high. In fact, it's been rising over the last couple of months. And of course, it's very difficult for the Fed at this current time because they really don't know what's going to happen to the inflation outlook given all of these sizable tariffs. So it's just really hard for central banks to be preemptive in a way that maybe we got used to in the past. So my second sort of semi-obvious point, this chart here is just showing you a rolling standard deviation of inflation across the euro area, the UK, and the US. And what you can see immediately, and which we all probably know, is that inflation has just become a lot more variable. And especially if we compare to the previous, lengthy periods where we had low, very stable inflation. And going forward, I mean, nobody knows what's going to happen, but it doesn't seem completely crazy to think that this inflation volatility could be with us for quite some time. We have, the risk of geopolitical shocks affecting energy prices. You have things like climate events affecting food prices. Energy and food, they have a really big weight in every consumption index, basket out there. And so it has a really big impact on inflation. So this could be with us for some time. And of course, this alone just makes the job of the central bank really, really difficult. First of all, how does the central bank extract the signal of domestically generated underlying inflation from the noise of the one-off price level shock? It just gets really difficult to do that. And we've seen that. We've lived through that in the last couple of years. It also really is a challenge to central bank credibility. Something I don't know the answer to, but how do you explain to people that you are an inflation targeting central bank if inflation is way far away from the target and for many, many years? That is a communications challenge. And we've talked about some of the ways already today how you might mitigate or strengthen that. We've talked about goal independence for the central bank. Others talked about bolstering the financial independence of the central bank as ways to enhance credibility, specifically because in this environment, it just becomes much, much harder. So my third point is completely speculative, which is, what are the implications of more volatile inflation, a world where it's harder for central banks to be preemptive, either because you're in a situation like we were in 2021, where you're worried that you might be overzealous, in hiking and end up tipping yourself further, below the zero lower bound, or in a situation like today where you're worried about being preemptive and cutting aggressively because you're unsure, what this is going to do to inflation expectations and wage growth. So if it means that the central bank, other things equal, has to respond more with a lag, then it could be that when they do respond, they have to be a lot more aggressive. They've got to hike interest rates by much more in bigger increments over shorter time periods. It could be that when they start cutting, again, similarly, bigger cuts over a shorter time period. And if we think that we're still not miles away from the zero lower bound, that could have spillover implications for central bank balance sheets. So this chart, just to explain, is the Fed's balance sheet as a percentage of GDP. And the bit to the right of this, dotted line is just something I, had fun with. Can you imagine that perhaps potentially going forward, if policy is a lot more responsive, that instead of going back to this period where the size of the balance sheet is quite stable at, whatever percentage of GDP, it's something that actually needs to evolve, more over the cycle as central banks are forced to do more QE and QT on a cyclical basis. So those were really the main 3 points I was going to make, and I'll leave it there.
Thanks. Very interesting, Katharine. Gianluca.
All right. So thank you very much for having me in this panel. It's a pleasure to be here, and I want to talk about what I refer to as the flip side of monetary policy. I'd like actually to offer a complementary perspective to the conventional view in terms of the transmission mechanism of monetary policy and the implication of monetary policy. And it's a complementary view. And I think the difficulty, and I concluded this at the end, is that in designing monetary policy, you need to understand where you are in terms of this balance. And let me start here with something that is been already emphasized. This is the composition of UK inflation. Is very well known in terms of the persistence lately of the service component of UK inflation. What I want to stress here at this point is the other line that you see going up, and that's the housing component of UK inflation. That housing component is relatively sizable. It's just below 20%. And for many households, it's even bigger in terms of their consumption basket. So that has been going up, and it just very recently slowed down, but still above 7%. This is my representation of the current Bank of England scenario. And they have two scenarios based on the latest monetary policy report. The focus is on domestic inflation. They say basically, depending on the relative balance between demand and supply, we might observe persistent inflation or a decline in inflation that is more rapid than the baseline scenario. Now, what's interesting on the first scenario, which is on the left side, is a black blur, but they are the driving factor, from my understanding of the report, is given by trade issues, or tariff issues broadly defined. While on the right side, the second scenario emphasized a lot the role of second round effects and inflation expectation. And also there is the, of course, dominant issue of higher nominal wage growth. So that has been pointed out as a key factor in driving service inflation. Okay? So that's the background in terms of how, I would say, the Bank of England is framing the current inflation outlook. And of course, they draw their policy implication based on this scenario analysis. The transmission mechanism comes from the scenario analysis. Now, what I want to stress here first is what has been driving inflation. And that is something that has been acknowledged even from the central bank point of view, central bank's point of view, in terms of global factors. I think this is important. And this is important also for communication, because it's important to acknowledge that there are factors that at times comes from external side, which the central bank cannot maybe do that much. So that's the first aspect. What are the global factors? Here, the first graph is actually coming from a paper I've been working on for a long time with my former colleagues at the New York Fed, in which what we show is only global factors that we identify in terms of the global supply chain, in terms of a global demand component that comes from supply chain dimension, and in terms of oil shock. You can see there, these are deviation from the historical mean. There is a lot that is accounted by these global factors, especially at the level of the global supply chain disruption during the episodes of increase in inflation. Now, the other aspect, though, that is important is that what I want to stress, and this is a part of the flip side, is that actually monetary policy is also a cost channel. And this cost channel is important in terms of thinking about that rent component that has been going up, and been going up quite sizably very recently. So these interest rate increases have been passed on tenants for landlord point of view. And also, who among landlords is not necessarily a mortgage owner might have past increase of interest rate because of arbitrage towards tenants as well. Now, the other aspect that is also important, specific to UK economy, is the fact that there are a lot of index and regulated prices, which this is the bump that you forecast in inflation in the forthcoming months. So which you acknowledge these are temporary, but of course, there's not much there you can do unless, of course, those are indexed on past inflation, and inflation is something that can be effectively controlled. The second graph shows, over time, going back to 95, this relationship, loose or suggestive, between actual component of housing and the actual rent and interest rate movements. The second aspect is, what about wages then? You know, why these wages are persistent? I don't think that is the issue. Why that's not the issue? Many here would think about one side of wages as the determinant of input. But there is a flip side of that. Wages are actually relevant in terms of demand. So actually, if you look at that, this is the first relationship between what we have observed in terms of wage inflation, nominal, and service inflation, the first on the top. And you know, this relationship is very tight pre-COVID, but it's broken a bit after COVID. And actually now, overall nominal wages have increased, and still we are observing a decrease in service inflation. The second graph actually is very interesting to me because I look at UK real wages index at 2015. And as you can see there, actually, we're just barely above the peak after the global financial crisis, or just at the time of the global financial crisis. So we're just above there. And if I take the trend from 2015, where real wages have moderately increased, then we are just above that trend, okay? So the way I would think about this of wages actually is income that is actually helping in absorbing even the monetary policy cost channel in terms of higher rents. And it's true that still savings are high up for reasons that have been discussed also in the previous panel, but still what we have here, we have a situation in which I would think about wages, and we can do also some analysis on that, in which wages are not key determinant of input, but if anything, actually wages are helping in absorbing everything that has happened to the economy. Now, what is the implication for policy here? And I draw a few implications. I would say less cautious and gradual, more convinced and regular. That's what I would say. Interest rate cuts actually do support spending. They limit the cash flow channel and might reverse the cost channel down the line. What are the other effects? There are benefits in terms of fiscal policy, because these two actually are very well connected for various reasons, through the balance sheet and through interest rates themselves too. And of course, there might be side effects in terms of exchange rate, but the current climate actually would be favorable, in my opinion, in terms of supporting a regular, as I said, rate cut as opposed to something that is more cautious. To conclude, keeping rate hikes might contribute to inflation persistence. That's the way I see it. If I look at the flip side of it, nominal wage growth supports aggregate demand more than it acts as a cost driver. And in a demand-efficient economy, like the one that is the UK currently into, with structural low productivity, the direct impact of tariff on the UK economy, I think, is less relevant than a deficient demand that is underpinning what's happening in the UK. I would say there are more certainties than uncertainty in the current policy landscape in terms of the policy, and that's the flip side. Interest rate, I would say, should be more aggressively cut. Thank you.
Right. Thank you very much to the speakers there. I thought I'd do my little summary of them, so correct me if I'm wrong. But so, Megan, you seem to be saying that disinflation is in process with the trade. The trade war is actually a tailwind to that process, but there's humps along the road. Katharine, your points about it sounds like it's a very hard time to be a central banker. You can't be preemptive, or possibly you can't be preemptive, so you have to be reactive, in which case there's going to be a lot more volatility in policy making. And Gianluca, you see the flip side of policy here, so the central banks need to work harder to lift demand, to wage growth, don't worry about it, it's offsetting the escalating housing costs that are such a big part of everybody, well, lots of people's spending. So we're going to go on to a little question and answers here on the panel, and then we'll come to the audience. So do get some questions ready. So we'll do this for about 15, 20 minutes. Everyone's been very well behaved here. They've done their talks in the 10 minutes required, so we're making good time here. So, Megan, I thought I'd start off by putting you on the spot. We obviously had the decision last Thursday, and you voted for a 25 basis point cut. I just wondered if you would have voted for that rate cut had there been no US trade wars, because obviously you've mentioned that as being a disinflationary process, a part of the setting here. And now that we've got the US-China de-escalation, which the governor said last week may be of more consequence for the UK economy, how has that influenced your decision? How is this de-escalation that we've got today influencing it?
Yeah, thank you. So you're right. I do think on net, trade should be disinflationary, but it is pretty uncertain. There are both inflationary and disinflationary forces. I came into this last round quite torn about whether to hold or cut by 25 basis points, in part over the concerns around constrained supply that I mentioned, and also concerns around inflation expectations and whether those might feed through into second round effects. I decided to cut in part because of trade. Would I change it all now, given this morning's news on a trade deal? No, I wouldn't. I think in terms of kind of the risks around our assumptions on trade, I guess I'm worried that trade diversion might be more disinflationary than we have in our central forecast. And I think that's still the case, even if Chinese and US tariffs are lower for 90 days, and then who knows what. I also think it's worth pointing out that China is a big piece of the picture, obviously in the global economy, but the EU is the UK's biggest trade partner. And so what happens with tariffs between the US and the EU also matters, and we don't have much clarity on that.
Yes, yeah, absolutely. I guess one of the things I was interesting is almost, because we're seeing the analysis from the bank didn't suggest that there was a huge impact from the tariff, the global trade wars, on either inflation or on growth. I just wondered if you could remove that from your analysis and just look at the domestic factors, would that have changed just the underlying domestic economy? Would your vote have been the same, or would there have been differences of opinion within the committee, quite stark differences or not?
So, I mean, we said in our minutes that some of us were a bit on the fence and thought trade was a factor. Some didn't, actually, and they voted for different things. And so, you know, if you're just looking at the domestic factors, I guess that would change it for those members who were considering trade as something that pushed them a bit over a line. But, you know, ultimately, we're setting interest rates to try to achieve 2% inflation in the UK, and have to consider those factors that affect the UK economy, but also the ones that we can do something about. And so it's the domestic inflationary factors that we focused on more than the trade factors.
Great. And Katharine and Gianluca, again, obviously the US tariff was the backdrop to everything at the moment. So I just wondered about how you thought today's de-escalation might factor or just filter through into monetary policy making here in the UK at the Bank of England. Do you think it's going to make it easier to cut, or is it again just such a peripheral issue, and I'm overstating it, others are overstating it? Katharine, I'll ask you first.
So, I mean, my sense is that probably the most immediate effect is going to be to reduce some element of uncertainty, given what we've heard in the last week and today. And that in and of itself should help to reduce the more deflationary impact side in terms of demand and overall inflation. For the UK, I mean, I think this is the comments others have already made, is that, you know, the direct effect of these trade tensions is probably a bit of a sideshow compared to just the global spillovers. And, you know, as Megan has very rightly pointed out, you know, what happens between the US and the EU is, I mean, I have no special insight whatsoever into what that is going to look like. And I think that the impact on the UK could be pretty significant. So I can see, you know, that fact, and it's just probably too soon to know in terms of any data what the tariff impact is going to be, that, you know, any decision really is going to be keyed off what you're seeing in the here and now in terms of domestically generated underlying inflation.
Right, thanks. Gianluca?
Well, yes, I tend to agree with both Megan and Katharine in terms of their assessment. I think the Bank of England in his report has been very clear in terms of distinguishing between direct and indirect effects, and also in terms of looking at tariff per se, and this measure of trade uncertainty that seems to be relevant in terms of the global demand outlook. I would like to add a couple of things on top of that. The first one is on these measures. I think, of course, they reflect the emphasis on this important issue of a tariff, but of course also they are not, in my opinion, time as we saw, or we are seeing actually with inflation expectation, for example, a shorthand in the United States, there might be the inflation expectation in the United States at shorthand are very much affected by political partnership. So I would say maybe we should look more carefully at measures that might not be biased and these measures, these trade policy uncertainty measures are all constructed from newspapers, selected newspapers, and they might be reflecting, what's happening. Of course, in some ways it's important, but what is important is to look at business decisions, how those are affected, and when we see changes in those decisions or changes in consumer behavior, that is when I think there is more worrying. In terms of the broad outlook, I see that, again, UK less exposed, also because they trade more services than goods, especially with the US. And I think more relevant is this US-China confrontation and what is coming forward. It seems that the current headlines are relatively positive, but still, if I can add something here, let's think about the worst case scenario when the new US administration was elected. And I think we are very close to that worst case scenario now. And what has been happening in the past few months was something that was, of course, very disruptive. But we're going down towards something that back then was the worst case scenario. So it looks good, but maybe it's not so good. So that's what I'm trying to say, at least if we based ourselves on that knowledge back in November.
It's better than dreadful. So,
better, but that's how you manage expectation, right?
Yeah, absolutely. And Katharine, you did, it was interesting, your points about the preemptive, how it's hard to be preemptive. And in a world where you do have incredible volatility caused by whatever policy is going to come out of the US, if you're a Bank of England policymaker, how do you deal with this when you've got the 3-year trajectory for your inflation outlook, and that comes back to 2%? It always seems to come back to 2%. But do you deal with the here and now in your policy making? So you've got this kind of a shortened, abridged time frame for how you set monetary policy, or do you still look out through the 2 to 3 years? So as you raised it in your remarks, I just wanted Katharine to come to you first.
Well, I mean, the reason why I raised these points was more, to highlight the potential that maybe we need to adjust the framework, maybe we need to think more about the central bank toolkit, given that the world in which central banks are operating is changing. We already touched on that earlier today. Do we need to rethink some elements of the inflation targeting framework? If it is, other things equal, a more challenging environment for central bank credibility, are there things that we can do that would enhance that credibility? And I think there was some hope that under a new government, you might see some more steps in that direction. We've talked about financial independence. I think, I'm persuaded by the evidence that financial independence does bolster operational independence. And I think that the structure of the central bank balance sheet, which we discussed in the previous panel, that came from a good place. The UK is scores really high on transparency and openness, but sometimes transparency can kind of bite you in the butt. And I think that really happened in the fall of 2022. And you can have, is what Ray Dalio says, radical transparency that is not actually helping you in real time. And so, maybe that's something that the UK needs to think about. It's not something the Bank of England can talk about, but, we can talk about it. So I raised that. Another one is around goal independence. I thought Andrew Benito raised some really good, cautionary, reasons for maybe not doing that. But, let's have the discussion. Is there a benefit to the bank being able to have goal as well as operational independence, thinking about maybe including housing in an inflationary measure to be more, credible, I think, to the UK public that they are actually targeting a measure of inflation of stuff that people really buy, which includes their housing costs. And then things around, the central bank balance sheet. How do you do, QE and QT? I'm a little bit worried about some of the things that I hear from central banks, maybe in particular coming out of governing council members of the ECB, that seem to be really kind of walking back, wanting to use the central bank's balance sheet. And again, I think these are very reasonable, concerns that policymakers have, but maybe there are things we can do to the toolkit to make them more to make them more usable, to kind of fill what some see as a democratic deficit in the use of these central bank policies. So, to answer your question, I think the Bank of England has really done an excellent job given the structure that it's given. I'm biased, I did work there for many years, and I am amazed at the public service that you see, day after day coming from all UK institutions. And I think they're doing as good a possible job as they can. But maybe we need to have a conversation about changing that structure, given that the world we live in is not as easy as it was in, the nice decade, or even in the period before COVID.
Yeah, loads to unpack. I can see Megan's itching to get in here.
Yeah. No, thanks. So, I think effectively you're saying it's really hard to forecast now, and the days when we could produce the central forecast and say, look, that's how the line goes, and so that's exactly how we should set interest rates are not the ones we're living in now. And I totally agree with that. I think the structure that needs to change is kind of how we're doing things, and that's exactly the point of us bringing out these scenarios and coming up with mechanisms to say, well, what if the economy looked a bit different this way? What would the implications be? So that we can bring kind of operating and risk space more centrally into our discussions to try to set monetary policy. Claire mentioned earlier that we spend some time thinking, well, what if we're in this state of the world, but we thought we were in this other state of the world? What are the costs of those mistakes? That's also coming into what we're doing as part of scenario analysis. So that is part of the answer to kind of how do you set policy optimally when you're living in a world where it's really difficult to forecast.
And to Katharine's points about actually reduced transparency might be sort of liberating. So should the bank be more secretive? I mean, is that a...
Don't ask her that. Don't ask her that.
Also we are where we are, right? So we have a certain amount of transparency. I think generally transparency.
Would it have been,
particularly
with the QE portfolio, would it have been easier to have had a different accounting framework which kind of concealed... Well, we were very transparent with the sale.
I think we have been very transparent, particularly around the balance sheet. I think in terms of what I do as the central part of my job, it's to try to set interest rates, but also explain the reaction function. And I think transparency is generally useful for those.
And scenarios will improve that transparency.
I think it should.
Gianluca, any thoughts on?
No, well, I do agree on, especially I think the recent upgrade with this scenario analysis. I think it's very interesting to see central bank communicating clearly how they see the economy evolving and the risk on the inflation outlook. I think it's my personal point of view is that is going to spread towards other central banks in terms of adopting this framework. So I think I welcome this pioneering effort by the Bank of England. In my remarks I was trying to point out, maybe it's one difficulty of this scenario analysis is the fact that you need to be sure in terms of what is the right transmission mechanism that is relevant at a particular point in time. So there is that dimension of risk in terms of thinking about what is actually really going on, what is relevant in this particular conjuncture.
Thanks. And on just a quick one on QT, just because we've had some changing developments there. I think the long-dated yields bonds were a sale of long-dated bonds was switched to short-dated ones. In particularly volatile times, is there an argument to say that QT should be paused or even completely altered because of what's happening in markets? The implication being that the idea that QT operates in the background may not be entirely true.
That's coming to
So
me.
you, Megan, first.
Yeah, sure. So there is a knockout clause in our QT which says effectively if QT is actually distorting the markets, then it gets rethought.
And but what point would that happen? Would it be particularly volatile markets then for it to be?
Whenever markets get distorted. So it could be more volatility, it could be bigger moves. But generally, whenever we through QT are distorting the markets, then we rethink QT. That's baked into our QT program, which isn't the case for all central banks. But you're raising this in the context of having swapped some of our QT operations, and that was purely operational. So it doesn't change the total amount. It doesn't change the angle. It doesn't change kind of the equilibrium level of reserves. It was purely operational.
Okay. And do either of you, Gianluca, do you have any thoughts on whether asset sales are disruptive?
Well, the Bank of England, differently from other major central banks, is engaging in active quantitative tightening by selling securities that they bought in the past. So I think that is more aggressive. I mean, if you look at the picture in terms of the policy tools, potentially QT is putting pressure upward on the long end, and the short term is on the declining path. So there is they are going in kind of a different direction. I mean, one is more contraction, and the other is supposed to be expansion. That's what I mean. So that is one dimension, and the second dimension that is important in thinking about this QT is the fact that is an important component of the interaction between monetary and fiscal policy, and the fact that there are losses that need to be indemnified from the Treasury is also putting pressure on the fiscal policy side. So it's creating another loop that is contributing indirectly or to a deficient demand outlook. That's the way I see. So it is an important aspect, and maybe to think about that dimension in a broader way, not just in terms of the reserve component, which is the way that is guiding the QT, but broadly speaking, in terms of monetary and fiscal interaction and the supply of liquidity in the system.
Complicating things. Just before I come to the audience to get your questions ready, I'll just ask one here. Jerome Powell recently used the word transitory again. And I just wondered whether transitory is back. I mean, can we use the word transitory without fear now, or was that a one-off? Katharine, I'll come to you first.
I mean, I don't really think it matters that much. What will really matter, I think, is that the Fed is seen to be setting monetary policy in a way that is appropriate to the inflation outlook. And this kind of links to your QT question, because I think a sort of unintended and unfortunate side effect of the period during which we had QE intervention was that we started to sort of conflate two things that really are separate. I mean, they are related, but for ease of exposition should be thought about separately, which is there is the stance of monetary policy, and then there's the role of the central bank as a lender of last resort. And when central banks were doing QE, they were kind of doing both of those things at the same time. But we're not in that world now, and I think it's very important that we separate the different functions of the central bank. So when all this, kicked off after the beginning of April on Liberation Day, some of the stories I was hearing in markets was, oh my gosh, the Fed is going to have an emergency meeting. They're going to have to cut. They're going to cut 5 times this year. And I was thinking, I'm really not sure that that's what they're going to do if they think that markets are really not functioning, if there is really a liquidity problem, 100% they're going to intervene, and they're going to intervene in real time. But does this actually mean that they're going to change the setting of monetary policy? That's a different question, and it's not obvious that A, they would have an emergency meeting, and B, that when the time comes for them to have their next meeting, that they would obviously be cutting. So I think we just have to be careful now in, giving some thoughts to the Bank of England, who I think have actually provided a really good model of separating these two things. A, they were super clear about when and how they were going to do balance sheet runoff in a way that no other central bank has been so clear as the Bank of England. They literally gave numbers. And then the second thing is that when it all kind of went pear-shaped in September and October, the knockout clause that Megan talked about, they said, okay, obviously now is not the right moment to start QT, but they were back in the game way sooner than I think most market participants could have believed in September. And they were able to, separate that communication in a way that I think, was very effective. Yeah.
Any thoughts on whether, obviously we have gradual and careful here in the UK as our guidance, so that is doesn't sound like transitory, but
that's right. I mean, I'll just highlight that I rolled out our 3 inflation persistence indicators for a reason, because I think they're generally still looking too high. They're moving in the right direction and focused on kind of concerns around supply constraints in the economy. So I don't think that we can kind of pull out the ticker tape and suggest that it's transitory. I think there are still reasons to be concerned about inflation persistence, and to consider that inflation persistence has come down in part because of our monetary policy stance.
Yeah. So thread open here. Yep, Silvana, and then the lady behind her. And then along next to Charlie. I'll take these 3 first. So there's a group here.
Thank you for the panel. Silvana Tenreiro from the LSE. So compared to February, the main forecast was conditioned on a lower path for interest rates, with a downward shift of roughly 50 basis points. Yet cumulative inflation over the forecast was revised downward by 60 basis points, and there was also a downward revision to the output gap. So could you walk us through the factors that explain this big revision downwards? Thanks.
Okay, thanks. Patrick Gerard, so University of Cambridge. I have 2 questions. The first one is, Gianluca, you mentioned that keeping rates high may contribute to inflation persistence. How important is that channel quantitatively? And is it so strong that higher rates, policy rates, would actually cause higher inflation? And if so, would it be better to look at different measures? For instance, the UK previously used RPIX, which excludes the effects on mortgage payments and so on. And my second question is related also to the inflation measure. Katharine mentioned, maybe we should have a broader inflation measure that should include housing. So what does the panel think about changing the bank's inflation target measure from CPI to CPIH, which includes owner-occupied housing costs, and which is actually the ONS headline measure? And interestingly, it shows quite a different picture, more worrisome picture. Core CPI inflation is currently 3.4%, whereas core CPIH inflation is actually 4.2%. Thanks.
Thank you. So Megan, so the first question was effectively, how do you square looser financial conditions? Oh, you've got a, okay, thanks.
Sorry, hi, I'm Arush from KBS. So following the trend of the bank rate cuts that the Bank of England has imposed in the past and predicted for future as well, and the fact that this panel agrees that the trade war wasn't somewhat relevant in determining the rate cut that happened on Thursday. So what could be any external factor apart from the trade war that could influence a decision? It's a 2-parter, and can something like, the potential EU ban on Russian natural gas imports in 27, which is right now in discussion, be an influencing factor in this decision and the inflation outlook in general?
Okay, thank you. Yeah, so the first question was how do you square the looser financial conditions in the latest monetary policy report with the lower outcome for inflation? So I think maybe if you could answer.
Yeah, sure. So I would say that financial conditions didn't loosen, they tightened actually, and that's because the yield curve shifted down quite a lot. You're right about that, but there was also a shift in FX. We also, had a global demand shock as part of our forecast, and energy costs came down quite a lot as well, so that on balance reduced the inflation forecast, but not massively, I will say. It wasn't hugely different from where we were in February. So it's all of those factors together, but part of it is that financial conditions overall didn't loosen, as you might expect if you were just looking at the yield curve. Yeah. Should I also answer the other questions?
Yeah, I suppose the last question there about trade wars and what other external factors apart from that can be influencing policymaking at the moment.
So I would say that trade was a factor for some MPC members in this last round. So it might not have been as big an impact on GDP and inflation as many people expected it to be, but it still was a factor. Though I wouldn't want to overstate it. Other global factors that came into our reaction function was global demand generally off the back of that. Also, fiscal changes in Germany in particular since the last time we had met, that comes into it as well. So that all feeds into our forecast. On looking
CPIH?
Yeah, on looking at different inflation metrics, you shouldn't think that we just look at CPI, headline inflation, because that's not the case at all. We slice and dice inflation many different ways. Do I think that we should focus particularly on CPIH? I wouldn't. I think one counter argument to the notion that rents are so crucial and that real wage increases have absorbed that is that, as you pointed out, the savings rate keeps ticking higher. To my mind, this is one of the risks in our forecast, in that we have the savings rate ticking a bit lower and consumption recovering. I think when you talk to firms, when you talk to our agents who talk to firms, they've all been saying, well, this drop in the savings ratio and increase in consumption is definitely coming, and it just keeps getting pushed out and pushed out and pushed out. So there is a question about kind of what's happened to the UK consumer, but it does sort of serve as a counter argument to the notion that real wages are actually just absorbing higher rents, because actually people are sticking higher real wages into their bank accounts.
So when you say you're keeping an eye on all different measures of inflation than just CPI, with that, because there has been in the past a lot of talk about moving to a CPIH inflation target, which would draw us more into line with other central banks as well. Would that be a good idea, or at the moment it just isn't appropriate?
Well, in fairness, other central banks have multiple indices that they look at as well, right? The Fed has CPI and PCE, and so I think we similarly look at a bunch of different ones. So do we look at CPIH? Certainly. Do we talk about the housing market? Absolutely, that comes into it. Do we slice and dice services inflation? Many different ways, as I showed you. Yes, I think actually what you have to look at is a bunch of different indicators to try to get a more complete picture.
Okay, thanks. And Gianluca, obviously, because it's an issue obviously close to your heart about the cost of rent. So CPIH,
Well, yes. Thanks for the question, Petra. I think actually there is a blog at the Bank of England that quantify this channel, and actually the conclusion would be slightly different in terms of the one that I would suggest. But if I look at the response to a monetary policy shock that is identified high frequency over time on rent, you would see actually that it's picking up quite, in my opinion, after 10 months. And now I don't know exactly how I'm going to quantify it, but essentially I think it's a very nice blog that provides a type of analysis, and in reading that I would say that it can be a relevant quantitative dimension in terms of the rent itself as a component, but also because that component eventually also ripple through other components of CPI. So that's, in my opinion, why I would say contribute to the persistence of inflation, especially service inflation as well. And yeah, that's what I would say.
Okay. And Katharine, do you have any further comments, but perhaps on the trade, what other facets might be?
I mean, I would just add that, last I checked, which is a little while ago, I mean, I don't think that big picture in practice it would mean anything different really in terms of policy, whether you switched from the CPI to CPIH. My reason for mentioning it was more from the perspective of just ensuring we really have a strong constituency for an inflation targeting framework. I think, most people, who hopefully don't pay attention to this stuff every day would just find it a little bit strange. Why is the central bank, targeting a measure that actually doesn't include the one thing I spend the most on? And anyone who's, lived in the UK for a long time, we're obsessed about talking about the cost of housing. So it's something that is on the forefront of people's minds. So it was more in that spirit, not that it's an indicator that the central banks are not looking at, or that it would mean something radically different in terms of policy, but just to give it that legitimacy, I think for most people would be a marginal improvement. And the fact that now the ONS actually has a proper measure that it's able to apply its national statistics status to is an advance, because I remember that it didn't used to. So why are we not using it if it's there now to be used?
Point. Right, over on this side. James on the second row. Chris at the front. And there's a gentleman. Oh, no, sorry, there's a lady behind in the stripy shirt.
Really interesting panel. Thanks very much. So I just wanted to ask two hopefully very quick questions. So just to link the first discussion we were having earlier, where I detected a little bit of confusion about the marginal news driving the change in policy between February and May, where it sounded like people were saying trade news is pretty likely to be a negative shock in activity terms, potentially disinflationary. And on the other hand, we have these domestic inflationary pressures, but a casual reading would suggest some positive news on those underlying persistence measures that the bank has been highlighting. So I was just wondering if I could invite the panel to say a bit more about the kind of marginal change in policy there. And let's be honest, I'm mainly aiming this at Megan. And then second, we're heading post-pandemic for another damaging recovery, depending how you think about the counterfactual, something like 5% off the level of GDP from that crisis. Do the panel see that as inevitable? I suppose I would hold up the example of what's happened in the US to suggest it's not. And if so, what are the kind of behavioral drivers of that very weak recovery? What should the government be thinking about in terms of addressing our kind of big structural hits to growth that we've had through that period? Thank you.
Thank you, Chris Giles from the Financial Times. Gianluca presented a really interesting thought experiment, which was effectively that lower interest rates through the housing channel would lower both inflation and improve the outlook for the UK economy. I wanted to ask Katharine and Megan what's wrong with what he said. And Gianluca, I wanted to ask you, in what way does your view of the world for the UK differ from President Erdogan of Turkey and President Trump of the US?
Hi, Emma Taggart from The Telegraph. It's just for Megan. I was wondering if you thought that policies enacted in the autumn budget were impacting the economy more or less than tariffs. And I'm really interested in your slide on businesses' uncertainty over NICs. I was hoping you could explain that a bit more. Thanks.
Right. Okay, thanks, guys. Megan, I guess come to you first with the question from James. Yes, and if the trade wars are not, the trade wars are not the big downward influence on policy that we feared, then what's really going on, and what should we be doing post-pandemic in terms of industrial or structural changes to try and boost growth?
Sure, I'll address the first one. The second one, I'm not going to comment on government policy.
Yes.
Yeah, but in terms of kind of the marginal news, effectively the headline I tried to start with, which was that the disinflationary process is on track, and so there has been progress since February. For example, in our indicators of inflation persistence that we've used for ages. So there has been some progress. I think where you are now on the monetary policy stance depends in part on where you were before, right? And so overall, the MPC continues to be gradual and careful, which suggests there are two-sided risks. Some of them come from trade, some of them come from other things like the NICs, which I'll talk about in a second. But there are two-sided risks, and so there's a gradual approach to reducing monetary restrictiveness. Did you want to?
Yep. So, Katharine, why don't you also address what other things have been depressing growth in the UK and should be, if there's anything the government you believe should do to try and restore our growth potential?
What can I say? There are a lot more clever people than me. I mean, I can give you my thoughts. In the previous panel, we talked about fiscal, and I think, we have to accept the fact there is no such thing as a perfect fiscal rule. And the UK is going to be in a difficult place, whether it retains its existing rules or if it tries to change them. That was essentially the takeaway from the previous panel that I got. But I do wonder, is there a middle road, which is the government able to make an announcement to commit to a new set of fiscal rules? Maybe these are fiscal rules, for example, that seem at their inception to have greater longevity because maybe they are agreed cross-party, for example, and where the government then doesn't actually immediately exercise the discretion that it gives itself by adopting these fiscal rules in order to build up credibility. So that could be potentially a way that you could tick those two boxes to, do the change in a way that doesn't make the market freak out and gives a sense that these changes are going to be here for longer than 6 months or a year or whatever it is that it seems to be the case now. But I accept that that's probably a very, very difficult thing to do. But I think the other main thing, and I think this is something that comes out of the discussion so far today, is that the central bank, crucially, cannot be doing the heavy lifting here. I think we got very used to a period before COVID where it was really the central banks that were doing most of the hard work in terms of putting a floor under the economic outlook. And I think my sense is that the central bank is much more in a supporting role now rather than being the lead actor here, and that it could be a false economy for a central bank to be signaling that actually that it's going to step up and take a leading role in the face of what are these structural changes.
So Gianluca, to Chris's question, I think he's basically saying that your approach is the Turkish approach to monetary policy.
No.
And so I thought you should defend yourself against this.
Yes, I'll try. First, I just want to go back to the previous question, actually, what also Katharine was saying. But I would emphasize the role of fiscal policy as an important factor in explaining also the difference between the US and other countries and why it is different. I mean, many other countries have had fiscal impulse during COVID too, but the difference is the persistent impulse in the US. And that is important from business perspective in terms of thinking about demand, which is crucial because, you plan ahead. And when you plan ahead, you see more demand coming, and that's why you want to invest. And that's also leads to possible productivity improvement, something that is missing here, has been missing for a long time. And I think that picture I showed you earlier in terms of the real wages dropping after the global financial crisis is a symptom of this demand efficiency problem. And it comes mainly from fiscal policy and the fiscal rules that are associated with that even more recently. In terms of the framework, why it is different? So what I was trying to emphasize there is that there are many ways in which monetary policy propagates into the economy. And what is important, in my opinion, or based on my little experience, is that every institutional framework is different from the others. We need to understand. So we tend to think many times in academia in terms of this mainstream new Keynesian framework, which abstracts from many things that are specific and important for each constituency. Now, this issue I felt was important in the specificity of the UK case in terms of capturing a dimension of the transmission mechanism of monetary policy and how it potentially affects rents and also propagate into the economy at the level of service inflation down the line. Accidentally, I've been in Switzerland. It's actually in Switzerland is even more explicit, this mechanism through a reference mortgage rate that determine how much landlord can pass on tenants in terms of rent. So it's even clearly spelled if you look at the SNB monetary policy outlook. So what I want to stress is you need really to dig into understanding what is happening at the level of each economy. Now, of course, there are many differences with Turkey and with Argentina you mentioned, but I think it's fair to say that my view is really acknowledging how things work specifically in each, and then maybe my point is to say maybe we need to acknowledge that at a certain point this becomes more relevant in terms of thinking about what policy should do, and clear communication in terms of understanding the channel and communicating that could help also in framing. Fiscal policies, though, is very important again, in terms of thinking about current outlook.
Do either of you have anything to add? Over here, there's a gentleman in the second row on the bend, and there's a lady at the back. Yeah. And at the back of the room, sorry, right at the back of the room, the hands up. Hand up.
So thank you to the panel. I mean, I guess this is slightly stepped back, but just having looked across both panels, we've had a lot of talk about QT and about kind of clarifying reaction functions under the heightened uncertainty at the moment. I just wondered, bringing those two things together, what the panel's view was around how a central bank would think about clarifying a reaction function or the monetary policy outlook when it has 2 degrees of freedom active on its kind of policy decision. So if we were to move to a world, put another way, where QT is part of the discussion, as Gianluca said, kind of reacting to kind of rates in the market going up, how would you communicate kind of the response across the 2 different policy instruments with just one objective?
Okay, thanks. And Vicky at the back.
Thank you. Vicky Price from CBR. Just wondered on QT, just following on from that, why is it, can we understand, we are continuing with the very monetary tightening, if you like, by active QT when the other central banks are not to that extent. And of course, the US Fed has reduced its QT per month very, very significantly. So I just wonder, since it obviously affects the interest rate that is charged on mortgages, and going back to Gianluca's concerns. And the second one, so I'd like to understand why we're doing it. The second one is on the transparency that we talked about, the central banks, which I think is a very interesting topic generally. Yes, it's good to hear, what your thinking is, but can we have a bit less transparency in the area of forecasting? Because I do remember a little while ago how the markets have been unnerved by the Bank of England going out and saying quite clearly that you got your forecast wrong, that you thought that inflation was just temporary, the uptick we saw, and we had to bring in Ben Bernanke to redo the model. I would suggest a bit less transparency there would actually be very helpful, since it actually proved to be temporary and transient. So I just wonder what your views on that are.
So, interesting. So, Megan, I guess you've got to take these ones. So, how does the Bank of England communicate when you've got these two different policy levers to pull, QE and interest rates in this kind of scenarios world?
Sure. So I think the insinuation was that QT would be one of our main tools, and it's part of our toolkit. But our main tool is, of course, moving bank rate. And so I might be misunderstanding your question, but I don't think there's a world in which we're going to have to talk about them both as having similar functions. And as being, our main tools. We have lots of things in our toolkit, including forward guidance, things like that. So I wouldn't think of having to communicate around them in the same way, because they're for separate functions.
And to Vicky's point, I guess she was pointing out that I think the bank's own analysis shows that QT has a very small effect on yield, so it does increase rates for mortgages for homeowners. So, she put it, why are you doing it? Why active QT, I think, is it necessary?
So the amount of gilts that we're selling is actually quite small. We have quite a long average weighted maturity of our gilts anyhow. And so, we'll look at this every September when we consider what to do with our balance sheet. But last September, we determined that it made sense to continue with active sales.
Katharine, should central banks be less transparent, as that would have avoided the Bernanke review potentially?
So I feel like not only do I need to answer this question, but also to clarify what I meant by that. You want to be transparent because you want people to understand, and you want to be able to explain. Yeah. The point I was making specifically about the arrangements that the Bank of England has that are unique is that it actually doesn't feel like it helped in that regard. It seemed to me that there was more confusion coming out of the setup, especially in September and October 2022, even though at the end of the day, from a consolidated, budget balance sheet perspective, there's actually no difference whatsoever between the UK's setup and every other major central bank that we look at. So it was in that sense that I thought that the transparency is not helpful, because actually it created more confusion than explanation. And to me, I think that's a little bit Vicky's point, which I think is a good point. And it's also dangerous when transparency is so extreme that actually it stops people from, thinking and discussing and kind of raising, ideas that are a little bit kind of blue sky, because they're a bit worried, what will people make of that? So in that sense, I think we just have to understand that there is sometimes a cost to transparency that we should factor into how we make these very important decisions. Yeah, let me just leave it there. I think it's lunchtime.
There's time for one more question, and then we're going to call it a day. Okay, first hand up was here at the front. So, gentleman
here. Thanks very much. So, Simeon Willis from XPS Group. Picking up on something that Megan mentioned about the toolkit, and then what Katharine was talking about in the presentation around the balance sheet size. So aside from QE and QT, what are the tools that are most likely to be used to manage the balance sheet?
Megan, I suppose.
To manage the balance sheet. Other than changing the size of it.
So changing the size. So this was a feature of something that Andrew Bailey was talking about at a similar event last year. And for instance, the repo market, using the size of your balance sheet to influence policies.
So I will say that the way that we manage our balance sheet is different from the way that other central banks manage their balance sheets. And there's a ton of research that suggests that actually you can skin this cat many different ways and actually have effective monetary policy implementation, which as a member of the MPC is what my interest is with the balance sheet. So we're moving from kind of reserved world into repo world, and that's something different than what the Fed is doing, for example. But you can have effective monetary policy transmission either way.
Gianluca, do you want to say anything on how central banks can manage their balance sheets in these alternative methods?
Well, what I wanted to stress again is that interaction with fiscal policy. The fact that there is active selling implies that there are bigger losses, if I am not mistaken, and that, of course, is a burden from a fiscal policy point of view and imposes a constraint on the fiscal side. So that's, I think it's relevant in terms of also going back to Chris' question earlier, in terms of thinking about what are the specificity of the framework and the fact that there is this indemnification is actually important for understanding the role of policy through QT and the interaction between monetary and fiscal policy. In the US, there's not such a thing because there is the defer program, so that create less of a burden from the US point of view. Well, we can discuss. Yes.
Great. Well, thank you. I think we're actually all done here. There's loads to consider and mull over the next over the lunch break. So enjoy it, and thank you very much to the panelists.